right.
Just raise one.
Welcome those of you who have already joined, and we're just going to give a minute for people to come in. This is the weekly Camo Plan webinar, and today's title is Why You Need a Non-Recourse Loan. And we're going to talk about the steps necessary to obtain one, why you would want one, what the impact is on your IRA, how you actually document what you're doing to stay compliant. Ryan, let me know when you got your slides ready, and we've got some things that a few housekeeping things. Again, we do this every week, and I'm going to go through. We have a small disclaimer. Of course, the lawyers all have to get involved. We don't provide investment advice. We're a custodian and administrator of IRAs, 401ks, and so we're prohibited from recommending or endorsing or promoting any investment products. So we're not CPAs or realtors or attorneys. And so if you need that kind of advice, we always say, before you do anything in self-directed investing, consult with your tax specialist, your CPA, if necessary, an attorney. All business done in a self-directed IRA, as the name implies, is between you and the sponsors of the investments you make. And so we're just the third-party ledger. We just account for everything. So it's just like in the old Westerns, when the gunfighting starts, don't shoot the piano player. So, and I think we're just waiting. Let Ryan know. Ryan, let me know when you're ready to roll.
Sorry about that. I didn't realize I was on mute.
All right, you ready to? I'll drop off, and you want to put up your slides?
Yes. Is there a way to share it on mine?
Yeah, you're going to go down to the toolbar on the bottom of it. Generally, it's at the bottom, and there's a share button. It's usually got a little green arrow pointing up. This is an Apple, so it might be, Lord knows. There we go. And I see it. And what you might want to do is, go to the slide version of it, so everybody sees it in full.
That work?
No, I think you got to. There it is. All right, we're good to go. So we invited Ryan Hughes. He is the president of Non-Recourse Loans, the aptly named company for what he does. He's got 20 years of lending experience in mortgage banking, real estate finance, alternative investments, leveraging debt for real estate, which is what we're going to talk about. He's also got a lot of experience in the non-recourse lending to IRA, and we're also going to talk about what that looks like in a 401k too. So Ryan, take it away. Glad to have you here.
All right. Thanks for having me, Joe. And so one thing I'm just going to cover what is a non-recourse loan, why why it's required, and some of the prohibited transactions and some disqualified individuals, what you should and shouldn't do. Of course, I do want to preface, as Joe mentioned, I'm not a tax attorney. Definitely discuss this with your tax attorney and get legal advice, for anything you're doing in relation to the non-recourse lending and what tax implications you may have, especially when it's related to an IRA inside of when you're purchasing real estate and selling it. So, and well, again, thanks for having me. And we'll go over this. So, what is a non-recourse loan? A lot of question all the time. What is non-recourse? Why do I need it? It's real simple. It's really just there's no personal liability. So to keep it simple, when you buy a traditional house and your primary residence, and you have liability. So they can come after the asset, take that property back if you default, but they also can go after you personally to recover any deficiencies from what they sold it for and what you owe with fees and also on the mortgage. So that's really what a non-recourse means. And so then the IRS, they require where you cannot personally guarantee any mortgage with inside your IRA and or 401k. That's one of the IRS regs. So we want to make sure you're compliant and you're doing it you're doing it the right way, and so you don't have to worry about forgiving your or paying tax and unwinding your IRA, and we definitely don't want that. So that's the biggest thing about what is a non-recourse loan. And then so typically what's required for it, what are we looking for? Typically, you're looking at the 1 to 4 unit. Now this is, I'm going to keep it pretty broad, Joe. So that, it's 1 to 4 units. You can do 5 plus. I mean, there's no restriction. It's just, every lender has different parameters, whether they'll do commercial, if they'll do, multifamily over 4 units. And so we all have different parameters in terms of what type of properties, how we want to do the appraisal. Of course, you're going to get the collateral reviewed. And we want to look at, it's called a DSCR, debt service coverage ratio. And every lender has that requirement. Those loans are pretty, they're out there all over the market, from just, traditional lending. So it's, you're taking the net rental income and then calculating based on the principal and interest. So, you want to have whatever if your net rental is $1,250 and your principal and interest is $1,000, then you would have 1.25 debt coverage. So it's 1.25 above the principal and interest payment. So that's how you calculate that. So net income, and then whatever you're left over, that's the 1.25 over your principal and interest. And typically on these, there are some lenders that will do fix and flip, but for the most part, you want to do buy and hold, long-term rentals. Some will do short-term. You just got to make sure when you're talking to lenders that you're asking, do you allow short-term rentals? Because Airbnb, the VRBO type stuff, and because some restrict those. They only want to do long-term rentals, more conservative approach. Typically, you got to have a little experience if you're doing the short-term rentals. It's just like a standard commercial loan. We want to see experience. And then you look at, I already went over the operating expenses, taxes, insurance, HOA. The utilities, typically that's not required to take out of your expenses, but we do, some do. So I want to put that in there just to reference it. And then also your management costs, what's your management fee? And then also there's a vacancy factor. So typically that's anywhere from 5 to 10%. I would use 10% when you're calculating when you're doing the preliminary numbers before you go to the lenders. So you have you want to always be a little more conservative, especially before you put an offer on a property. And then ownership structure, again, it's actually titled in the name of the sole into the IRA or the 401k. Trust name, if it's a custodial account, for Camaplan, then FBO, and that would be the name of the actual custodial account. So it just depends if you have if you establish an actual LLC underneath the IRA, or if you're just keeping it custodial IRA. So just however it's titled, that's the way typically we do it with a note and deed of trust.
It's the same for any of the assets. Those of you who already have accounts here and have assets, it's basically Camaplan. F is in Frank, B is in boy, O is in Oscar, for benefit of, then your name. And it does help if you put your account number after IRA and then account number.
Absolutely. I always say, make sure you check with, Camaplan first, and that it's, and they'll, I'm assuming Joe, you'll review the,
yeah, when we get to the end, we'll look at the process of actually doing it on this end.
Okay, perfect. All right. So the loan process, I don't know, hopefully all this is showing through, but
yeah,
typically the loan process is 30 to 45 days. I let everyone kind of start with that. Doesn't mean it takes that long. No, it just, it's all dependent on the title company when they get the title report, the appraisal, inspection. There's different outside variables that you need to that are going to determine how long it takes. But typically for us, you submit the property worksheet, which that most lenders have a similar format or requirement. You want the address, the taxes, insurance, HOA. You want the expenses. You want they want to know the monthly rental comparables for the market. So you'll submit the property worksheet, and typically we try to get that done, definitely 1 to 2 days. I'm, prefer to, it depends on how busy we are, but we'd like to get it at least reviewed within 1 to 2 days or same day, is our goal. And then typically after that, we're going to review it, let you know the max loan amount if the property qualifies. And then at that point, you can say, yes, I want to move forward. You'll do the actual official application. We do a credit application mainly just to know our customers, KYC. And, that's just, so no one else is out there trying to utilize your information to purchase an asset, fraudulently. So we always want to just make sure we know who we're dealing with, that, keeps everyone happy and safe. And so we get the application, you do the appraisal deposit. Typically it's anywhere from $500 to $650 for your appraisal deposit. Some may charge more. Again, that's, it's lender specific. And then once you submit that, we'll typically have a letter of commitment, within the next 24 hours. After that, 7 to 10 days for the appraisal, get everything, reviewed. And once we have that, we'll go ahead and schedule closing with the title company and get it closed. So it takes about, overall, I've done them as quick as 21 days, but on average it's 30 to 40 days. So
on the comps, I mean, when they initially, you're going to do an appraisal, but on the comps, do they just go to like, realtor.com and Trulia and Redfin and just get comps? What are the rules there?
I mean, some people can get a CMA, comparable market analysis, with the with a realtor, but
Okay.
you can start with Zillow or Redfin or whoever you feel comfortable with. That's, I always say, don't take the you don't want to go off the most aggressive numbers, but or at least take it in the middle. Be in hopefully where you're buying or you're looking to invest, you have a pretty good understanding of that market. And so you'll know kind of where the properties are settling at. And but again, that's why you pay realtors. If you're doing a FSBO, for sale by owner, then of course you can do your due diligence on with just the typical third party. They're fairly close. And then there's other things, a BPO, broker price, that we can help out with as well. That they're a little less than a typical appraisal, but we do it. So you can start with Zillow or any of the third parties. So
okay.
So one thing, with non-recourse are lenders out there. You definitely want to work with someone that understands that there's a handful that I've been doing it for a long time, 20 years, 15 years. And sometimes there's lenders that say they do non-recourse, but they have it's called a bad boy carve out, where there is some personal liability and they get you at the end. And and that's not because they're trying to pull a fast one. That's pretty typical. And you just want to make sure that you check that with your with Cameron Plan, your tax attorney, whoever's giving you guidance, that you're not going to run any problems if if you are audited and from prohibited transaction or lending requirements. But we understand it. We understand the structure of the IRAs and 401ks, and that allows you to actually make sure you're protected. We again, we're not tax advisors, but we try to look out for you're not going to get in a situation where you have a taxable event. So
do you want to get into, or are you going to cover the UDFI stuff at this point?
I will, yes. Let me go
All right,
into that. So
no worries.
So there's there are some prohibited transactions. I mean, again, this is just it. I'm going to just be a real high level. I would say, again, just disclaimer: talk to your attorney or CPA just to make sure you're compliant. But you can't. There's some disqualified. You can't persons, like you can't rent to family members, and there's and so you just got to make sure you can't use the property yourself. So it comes down to self dealing, and that that's where we're all pretty aware of that. So that's definitely, it's investment only. There's no no guarantee or personal loan personally, so you don't guarantee it like I discussed earlier. And then the one thing sometimes it happens with commingling of funds. I've had clients that will say, "Oh, I had to fix the whatever, and can I use my personal, personal checking account?" And no, you don't. You absolutely, you want to stay away from that. So that's just no commingling of personal assets when the property's inside your IRA. And again, check with your CPA, risk attorney. I know Campbell has has reference, has people they work with. So definitely just check into that if you have any questions.
There are some, would you rather hold the questions till the end or?
We can. I'm
Brian?
fine if we want to
Yeah, I
flow
like a
with it.
conversational. Gary is asking, can we borrow against a note, seller financed mortgage note or a CD?
So, sometimes notes are there's not many lenders that will do. I mean, technically you could. Just
Mhm.
that's something you'd have to check with the lender and if they're going to allow you to borrow against the note. And that's it's something that we've looked into at NRL, and it's definitely something that's I would say it's more of a case by case situation, and it's going to be probably a little more limited loan to value or loan to cost of that note, and also you just got to really look at the collateral package. Sometimes you get into seller finance notes or notes that are and it just really depends on the actual the way the documents are structured, and we got to make sure we have a security instrument and everything's properly recorded, filed, and all that good stuff.
All right. Well, that maybe is part of the reason or part of the answer to the next question. Donovan wants to know, I'm not understanding the relationship with NRL and how us folks with money in Camel Plan are using it to work with NRL. I lend to flippers now. How would this help? And I think, if you were purchasing property, I lend to flippers too, and I don't need, don't need a non-recourse loan for any of that. And my guess is that unless you're buying property with your money in your Camel Plan IRA, you probably wouldn't need that. Is that a fair answer to that question? Do you think, Brian?
I think so. I mean, it's one of those things. If you're lending money to flippers, typically you're not you're just lending money. You're giving them a private money loan, so
Mm-hmm.
you're not in an asset. If you were to have to acquire that asset, potentially, or where take that asset over, I don't know. That's something that we would want to get into a little more in the weeds.
Yeah,
And
that's
if they
a fun
default
horizon.
and you take it back, and then you need a loan to finish that asset, and
Uh-huh.
that's where you would come into anytime you're leveraging debt inside your retirement is when you need a non-recourse loan.
Yeah, and this comes up. I visit with the RIAs all the time, and the subject comes up. Well, I don't have enough money to buy in this market, a rental property, but they probably have enough, or they do have enough to do a down payment, and that's when the non-recourse option comes in. So,
Yes,
yeah, I
and
hope
then
those answers, Donovan, Gary. I hope those, hope that answers your questions. But feel free to chime in if we haven't.
yeah, and we can always dive in more to that, maybe offline or afterwards. Any of that type of stuff, I like to dive in a little deeper, and we can try to consult with some of these the risk attorneys and some of our
Mhm.
affiliates we work with, and just to make sure we're all we want to make sure we're compliant because we want to grow this space. So and then is there any other questions, Joe?
I
Or
think we're good for now. You're welcome, Donovan. No problem. Yeah, these are intended as with any of the presentations we have here is kind of an overview. It's a 30,000 foot look at something, and we encourage the people who are listening and who have registered and are listening to contact the guest, and that's he or she is here for that, and they love being contacted by people who've bothered to show up. So yeah, definitely reach out to Ryan. Gary, so your typical borrower is a real estate investor doing flips or landlording, and I think Gary, it's mostly landlording because they like to see a longer term hold. Um, Ryan, correct me if that's not the case.
you could do both. I mean, so I don't want to say that so there are fix and flip lending options out there. So I would say you can do both. It's not completely restricted. It's easier. There's a lot more. Again, there's more choices when you're doing it long term. But you can
Mm-hmm.
absolutely look at doing some fix and flip type stuff. It's typically on those, you'll leverage the asset and the rehab amount, which is, normally on a fix and flip loan, you can do like whatever traditionally, 85% of the purchase price and maybe 90 depending on experience. And then you do 100% of rehab. On these particular loans, you would more than likely, you're going to be stuck with just doing the asset, and then the rehab part would have to, come out of your retirement. So it's not really giving you the same benefit. But there are some, again, the lenders that do it, there's some different options out there. I don't want to speak to all the nuances of, each, lender, but you can definitely do them.
Yeah, there was another question by someone who said, do you finance properties that need repairs like fix and flip? If so, would it cover the repair cost estimates too? So do you bundle that in there? And I think you just said typically that comes out of the IRA.
It varies. I mean, there are some options out there. So it's not something that it can't be done. But again, it's just one of those factors of what's the ARV, and I always say, just like anything, I hate to say it, but it's, every project is stands on its own, and every sponsor, depending on experience and what you're doing, is gonna determine what that looks like, what we're able to do. So.
Okay, thanks.
So you mentioned earlier about UBIT and UDFI. Of course, UBIT doesn't apply to this, but the UDFI, anytime you're leveraging debt, finance debt, then you could be subject to the tax. So right now it's 37%. So you're looking at, when you borrow, say you buy a $200,000 home, 100,000 from your IRA, 100,000 from, where we're lending 100,000, 50% of that is leverage debt, and you go to sell that property at 300,000, so you're making 100,000 profit. 50% is to your IRA, non-taxable. The other 50,000 is subject to UBIT. So you would have, I'm sorry, UDFI. So you'll have the 37% tax implication on that. Now, for whatever reason, solo 401ks are exempt. Yeah, again, that boggles everyone's mind. But so if you have the ability to do an individual 401k, and you qualify for that, of course, Cam Plan can advise you on that and let you know if you do or don't, and then you avoid that UDFI tax.
Yeah, and
but again,
avoid UBIT too. So
yes, absolutely. So and then there's that. I put in there 990T. That's what you would have to file with, if you need to file that and pay your report and pay your taxes. So just if you have that, obviously it's great. I mean, some people say, oh, I don't want to do that. What's the point? But it allows you to. There are situations where you run the numbers and you can purchase an asset, and it still benefits doing, go ahead and leveraging debt, because you can still get a larger return and be able to scale at a much larger pace. So it just depends. You got to run the numbers and see if it makes sense. So this is just an example of just a case study. I went through this real quick, and it's an IRA, LLC, bought a property. It's a $250,000 purchase. Loan, the loan was $150,000. 60%. I use 60%. That's pretty standard. And you can go anywhere from 50 to 70. I mean, it just depends. Again, it depends on the lender, but I'm just going to use 60 as an example. 7-year ARM. A lot of these are 5, 7, 10-year ARM products, typically on a 20-year, 25-year amortization. So that's pretty common. So the rental income is $2,500 a month, and this is just again example. But DSCR, debt service coverage, 1.45. So the UDFI tax will be paid on the 60% of the net income. So that's where you're, when after you sell the property, you sell it for $320,000. After 2 years, now you have a $70,000 bogey, and 60% of that 70,000 is going to be subject to the tax. So that's and then you take that and times, now, like I said, it's 37% now. So and that will give you your number, what your tax liability is. This is just another one real quick, just another case study. Any questions? I mean, same thing, just want to just kind of put it out there. I had 35 in my bads because it was 35, so but they raised to 37. So this one, same thing. And I do want to point out on this, Joe, is, this is the property cost was 100,000. She did a $60,000. She had $60,000 loan that we did, and it was like, well, why not do 40,000? And and it could be minimum loan amount, but ultimately you want to have reserves, and you can't commingle money, so you want to make sure you have closing costs, you have a little buffer, 10-15% reserve requirement. Most lenders require it, and that's just to make sure that you're not, if something happens, you got to replace the roof or air condition, then you have the money in your IRA to cover that. So the property sold months later, 125, so we had a $25,000 gain. Profit split, 10,000 IRA, and then 15,000 from the leveraged fund, UDFI 15,000, which is 5,250 again. It's higher now, and so the IRA netted 19,750. So that just gives you a real high level.
That's not a bad, close to 30% return in a couple of months.
Yeah, not bad at all.
That's why you'd go through the trouble to do this.
Yes, because the whole point is a lot of people get into this, and that's why I opened up NRL is there weren't a lot of options, especially when you get in the smaller loan amounts. You had very limited options out there. So the goal is right. You keep doing it, you build it up, you buy more assets, and then now you have $1 million, $2 million, you just keep growing. So if you're doing that, you definitely want to try to be in a solo K or a Roth or some kind of Roth component. So. But you still have the UDFI even in the Roth situation. So that's some people, I think, are not aware of that. So, any questions? I mean, this is. I mean, if there's any other questions? These are some of the typical questions that we get. What's eligible? Again, land, if it's no income on the property, that's not going to work. So typically, land, manufactured housing can be very difficult. In any certain markets, it can be restricted depending on just where they are. If they're really remote areas, that can be extremely difficult just because the marketability of the project. So just again, that's something when you check with the lenders directly. We discussed the UDFI, how it affects your return, what documents are required. It does vary. We try to keep it pretty simple. The property, collateral, appraisal, title work, and then typically we want to know who we're lending to. We need the entity docs for the IRA, so we would need your actual documents for the IRA or 401k, depending on how it's structured, just to validate the entity and how we're recording everything. And then, can you refinance the property? Yes, you can. So that's something that could be out there. If you have properties and you have equity, we can pull cash out. Some lenders, don't, some do. So that's something that, it allows you to get money back into your IRA, and then you can go purchase more assets. So you can definitely do that. And then, so if you don't have enough reserves, you could look at maybe doing a partnership with someone, another IRA, or, private lender. I've had people do that. There's a different structure. Just, you got to check with the lender what they allow. And anytime you do partnerships or complex structuring, then typically you're going to have to pay the attorney to draw the docs, and it's going to cost more.
Yeah. On the document, you need to validate the existence of the IRA or the 401k. What do they need? A snapshot of a statement, or screen cap or something?
Good question. So we do want the most recent quarterly or monthly statement just to validate the funds for reserves. Now we do want to source it. Typically, we want to see at least 3 months, and that's really just to make sure it's we're checking that part. But then we either if it's a LLC structure, that's easy to get the articles and then show the formation docs of how it's structured. If it's if you're doing a 401k, typically adoption agreement, trust agreement, and then for the IRA, we want to see this. We always want to see the validation from CAMA plan for the IRA.
Okay.
And I think it's about tools. I mean, we do have some tools out there. Definitely reach out. I mean, please go to, like Joe mentioned, non-recourseloan.com. You can click apply now and put in your name, email, phone number, and that's all we need for you to inquire and ask questions. And but definitely if you want some calculators or other examples, or if you would, I know there's webinars out there. There's all over YouTube, all these different UPIT and UDFI, and I'm sure, and then also, of course, if you need help with the 99T, reach out to Camera Plan. I mean, we deal with some, but a lot of that stuff's online, and just
Yeah,
always check it with your accountant and
we'll
tax
walk
attorney.
through that. We have a couple of some questions. So what is the interest rate of a typical non-recourse
It
loan?
good
Gary's
good good
asking.
good question. It does vary, but what I normally what we see anywhere from they're typically anywhere from 3/4 to a point and a half over the traditional lending. So 7.75 to 9.5 is kind of the range you see out there in the market. So it's usually that's what we're seeing currently. And just depends if you go with a 5.7, what type of term you're going with, and do you have sometimes there's prepayment penalties on some of these, so check that. So it does vary based on the asset and loan to value. So there are some factors that go into that.
Okay. Then another question is, how do taxes apply to monthly income in the case of a long-term buy and hold? Does the tax apply only if the property is sold? And I think it applies to everything, the income generated by that property, the leverage portion, um, the equivalent
That
leverage
I'm
portion is
I'm
taxed, correct?
I'm gonna leave that out. From what that I would say that definitely double check that. I would say lean on your tax advisor, but from what I understand, it's only when the property's sold, um, and that's what you pay out on the gain of the actual asset. But again, definitely that's why I'm not the tax attorney on this one, so that's how I understood it. But again, verify that.
Yeah, and I've heard that the income 50% of it's financed, 50% of the income generated by the property would be subject to income tax. So
Yeah, it's good.
again,
That makes
always
sense.
consult. Yeah, always consult your specialist. I was going to spend a minute or two. Um, we've got some people who want the slide deck, and so what I'm going to do is typically what I do is we will send the contact information to Ryan for everybody. And Ryan, if you'd be good enough just to blast out the deck, because I'm getting um, you're getting a lot of requests for the slide deck. So are you good with that?
Sure, and I'll make some. I'm in the process of always making updates, so I'll send it out if that's okay, Joe. They'll get a little more updated version, which is
That's fine.
so
Yeah. Yeah, let's yeah, so I'll send you the registrants list, and then that'll have their emails on it and you can just blast it out to them.
perfect.
A couple of things about those of you who want to do this in an IRA or 401k, and let's assume you have an account and it's funded and you're ready to go. Let's skip all of those steps. The first thing you'll need to do is get all the loan documents from the bank prior to the close. And that's everything you're going to need. And all of the closing documents we'll need to review prior to the day we close. So what's going to happen is you'll fill out an asset purchase directive, and you will have two assets there. You're going to have a loan as an asset, and then you're going to have the property as an asset. All right. So we have specialists here that'll guide you through that when the time comes. And so all the closing documents will be there and they will be part of the closing process. Again, we'll walk you through that when the time comes. And then Camaplan would make the monthly payments per the mortgage, per the loan, and would provide you with information for the 990T that your accountant would prepare in order to pay taxes owed on any of the income or capital gains if you sell the property. And then all you need to do to set that up, it's a payment authorization. It's a one-time thing. You can set up a recurring, so set it and forget it. So it's pretty easy to do on our end. And again, the titling is on any of this stuff would not be you. Don't put a down payment down on a house and come back and try to do it with your IRA. You can't do that. So it would be Camaplan for benefit of FBO, your name, and then IRA or 401k. And it always helps to have the account number on there too. That's helpful for us. So I'm not seeing any other questions, and I'm going to ask the attendees that if you have any questions, don't hesitate. And Alex, you might want to put your contact information up there, right? If can you share that? Because the questions you can always send them to me.
I put in the chat, in the Q&A or the chat, or
Yeah. Tell you what, do you?
see.
Yeah, just put it in the chat and address it to everyone. Host. I've got host and panelists, but I want to just select everyone and put it in there. And then Ebony, you missed the first 10 minutes, and I may have missed the part of the concept in the last scenario. Did the borrower come to the table with 40,000 cash? After closing, are those IRA funds restricted in any way? So
What,
I've got Ryan multitasking now. He's putting his contact
what
information
was
in
the
the
question
chat.
again?
Ebony wants to know. He said she missed the first 10 minutes, so I may have missed a part of the concept. In the last scenario, did the borrower come to the table with $40,000 in cash? And after closing, are those IRA funds restricted in any way?
Good question. So it's going to vary on the lender. There is some that could be potentially restricted, but normally that's there for a reason to, yeah, if you need unforeseen repairs or expenses. So normally you are able to use the funds. I mean, especially if you need to use all of them for certain unexpected costs, then yeah, no, yeah, I know we typically will release those funds accordingly.
All right. And Ebony, Alex, everyone, we always send out a replay link. Sometimes it takes us a few days to do it, but just be on the lookout in your email because we know half the people who sign up for these things don't come to the real meeting because they have, they have other things to do during the day. So they watch them at night. So, or on the weekends like I do. So let me see if there's any other questions. All right. Well, listen, first I want to thank you, Ryan, for coming in and explaining this to us. It's a big part of what we cover as an option. Oh, Tanya, you should see if you pass if Ryan put it into the chat, you should see Ryan's contact information in there. There it is. All right,
Yeah.
Tanya. Yeah, Tanya, see if it's there for you, and if it isn't, we'll get it to you somehow. But yeah, Ryan, thanks so much for this. Is a big part of we cover it. And we say you can get a non-recourse loan, and we have some banks at our website that we can point people at. But really, this is normally it's the first time they're doing it, so it's great to have an expert and come in the house and show us how it's done. And if you're doing this for the first time, you definitely want to talk to somebody like Ryan, in addition to your own tax people and your own accountant. So thanks
Yes.
for coming on, and thanks for everybody for taking time out of your busy days to visit with us here.
Yeah.
And again, we'll be back next week at the same time. This is Camel Plan. My name's Joe. You guys have a great day.
All right. Thank you.